All right, thank you for joining us today. Welcome to our free class presented by Business Credit 101, powered by OrangeFi. Today's session is part 1 of 2, entitled Business Credit Builder, and this is a live video class for your benefit. We're going to go over a lot of material and cover a lot of ground, so get ready because we're just about to begin. Before we get started, I'd like to commend you for taking the time to seek out information that will enable you to be a better prepared individual and a business owner. You've made a great decision to spend this time with us today. If you've ever had questions about business funding or credit, this webinar is going to start with the basics and take you into information that you may not have known existed or even mattered. One of the most important things anyone can ever do is plan and prepare. You wouldn't take a road trip without a map or GPS guide, or at least some directions. So why do so many people put what could be one of the most important financial decisions they make at risk without first preparing? This class is designed to help you in understanding that roadmap and to help you prepare for funding. Let's first start by establishing the status quo. The status quo is what most people do, which is apply for loans or credit blindly, with eyes closed and fingers crossed, hoping that they get approved. Unfortunately, that approach is a shot in the dark to an unseen, unclear, and undefined target. What most people do is walk into a bank, respond to an ad in the mail, maybe they saw something on TV or online. All of them have one thing in common. They all want you to apply, and they will all tell you that you're pre-approved. But then they'll say something like, don't worry, it's only a soft inquiry. It's not going to hurt your credit. What they don't tell you is that if you get declined, what they'll say is, sorry, you'll receive a letter in the mail within the next 30 days explaining why you were declined. And if you get approved, well, that's great, except how do you know if what you just got approved for is the best option for your situation? Maybe you could have qualified for a better option. We're going to take a closer look at all of your options in just a moment. Once your credit score is past a certain number, everyone is pre-approved, but the credit score is not all that matters when applying for funding. What else matters? Well, in financing, there are 5 categories, otherwise known as the 5 C's of funding, which we're going to review. The 5 C's of financing are first, character, capital, capacity, collateral, and conditions. Let's take a closer look at character first. Your character, sometimes called your credit history, is the first C, and it refers to a borrower's reputation or track record for repaying debts. This information appears on the borrower's credit reports generated by the 3 major credit bureaus, Experian, TransUnion, and Equifax. Credit reports contain detailed information about how much an applicant has borrowed in the past and whether you have repaid your loans on time. These reports also contain information on collection accounts, judgments, liens, and bankruptcies, and they retain most information for 7 years. The Fair Isaac Corporation, or FICO, uses this information to create a credit score, a tool that lenders use to get a quick snapshot of credit worthiness before looking at credit reports. Before we move on, let's make sure we have a good understanding of the components of a personal credit report that you should be aware of and on top of. When it comes to your personal credit, again, the 3 major credit bureaus are Experian, Equifax, and TransUnion. Derogatory items such as tax liens, judgments, bankruptcies, late payments, open collections, unpaid child support, etc. must be addressed and repaired. The age and size of your active accounts are a major factor in your credit worthiness and in your scores. Lack of depth and history can disqualify you. Active revolving accounts should be under 35% utilization. In some cases, certain accounts are okay under 45%. Your name, employer, current address, date of birth, social security number, etc. can sometimes be reported incorrectly and should be corrected. An excessive amount of inquiries can lower your credit scores and disqualify you from certain funding options. Inquiries can be a big deal. The three major bureaus will either not show up as an inquiry if it's a soft pull, which means that the lender is just looking at your credit score. If it's a hard pull, that means they're gonna be looking at all three bureaus, and that's gonna show up on your credit for at least 2 years. A hard inquiry looks at just one bureau, and again, it stays on there for at least 2 years. The weight of an inquiry is 3 to 5 points per bureau. And as you see, little by little, inquiries can add up. After 2 or 3 applications, what started off as soft pulls can disqualify you from getting approved when you find the right funding option, because they add up. Let's talk about the second C, which is capital. Capital is the down payment or deposit a borrower puts towards a potential investment. A large contribution by a borrower decreases the chances of default. For example, borrowers who have a down payment for a home typically find it easier to get a mortgage. Down payments indicate the borrower's level of seriousness, which can make lenders much more comfortable in extending credit. The third C is capacity. Capacity measures a borrower's ability to repay a loan by comparing income against reoccurring debts and assessing the borrower's debt to income, or your DTI ratio. In addition to examining income, lenders look at the length of time an applicant has been at his or her job and job stability. The fourth C is collateral. Collateral can help a borrower secure a loan. It gives the lender the assurance that if the borrower defaults on the loan, the lender can repossess the collateral. For example, car loans are secured by cars and mortgages are secured by homes. The fifth is conditions. The conditions of the loan, such as the interest rate and the amount of principal, influences the lender's desire to finance the borrower. Conditions refer to how a borrower intends to use the money. For example, if a borrower applies for a car loan or a home improvement loan, a lender may be more likely to approve those loans because of their specific purpose, rather than a signature loan that could be used for anything. So in a nutshell, the 5 C's again are character, which basically speaks to your credit history; capacity, which is your DTI or job stability; capital, which is the amount of money you can make in a deposit or a down payment on the loan; collateral, which is what you're able to use as an asset that you can use to secure the loan; and of course, conditions, which speaks to the loan amount, the use of funds, interest rate, and the term. Let's talk about interest before we move on. The most popular form of interest is APR, which is annual percentage rates. There's 2 types. There's nominal, which is monthly, and then effective, which is calculated annually. Amortized interest first pays off the relevant interest expense for the period, after which the remainder of the payment reduces the principal. Simple interest is calculated only on the principal amount of the loan. Principal times interest rate times time equals interest. Compound interest is calculated on the principal and on interest earned. So principal times interest rate equals interest for the first year. Then for the second year, principal plus the interest earned on year 1 times the interest rate equals your interest for year 2, and so on and so forth for each year after that. There's also variable interest, which varies as market rates change. The prime rate, or the rate as reported by the Wall Street Journal's bank survey, is among the most widely used benchmarks in setting home equity lines of credit and credit card rates. It is in turn based on the federal funds rate, which is set by the Federal Reserve, also called prime lending rate, or even just prime. and it is the best rate customers can obtain. Currently, the prime rate sits at 5.50%. Fixed interest doesn't fluctuate during the fixed rate period of the loan. Let's move on and talk about funding options. What funding options are available? Well, there are options for startup businesses as well as for existing businesses. There's SBA, Small Business Administration, invoice factoring, equipment financing, self-directed 401k rollovers, business lines of credit, purchase order financing, credit card financing, business term loans, traditional bank loans, personal term loans, asset and collateral loans, private and hard money loans, and business or merchant cash advance loans. All of the options highlighted in yellow could potentially fund a startup. Let's take a closer look at SBA, or Small Business Administration. Well, first, SBA requires all 5 C's of lending. It requires collateral. In this case, real estate equity is required for most SBA loans. Capital, 10% for an existing business as a deposit, 20 to 30% deposit if it's a startup. Capacity, they want to be able to verify your existing business's revenue. They might want to see tax returns, bank statements, profit and loss statements. Or if you're a startup, they might want to verify income. And that means that they want to see that you remain employed. Stability is very important. Your character, personal credit is a must. You have to have good personal credit. If you have good business credit, then it's a plus. That's going to help you to get more money and better rates. Condition, the use of funds must be specific. On an SBA loan, you have to complete a business plan. Whether you have a business plan preparation, you'll have to complete or fill out a section which basically defines how the funds are going to be used. So it's important that you know exactly how you're going to use the money when applying for an SBA loan. And once you get approved, you really can't stray from that. You must use the money for that reason. The interest rate right now for an SBA loan is at 5.50% at the prime rate plus 2.25%. There are other miscellaneous fees that vary from one bank to another to get approved for an SBA loan. One thing to be aware of regarding SBA is that you can get an SBA approval letter from SBA. But what most people don't understand is that at the end of the day, the funds or the money is not being lent by the government or by SBA. They are simply guaranteeing the banks the money. So the bank is the one who's lending the money. As a result, each bank has its own criteria above and beyond the minimum requirements of SBA. So that's why you could technically get an approval for an SBA loan, but not find a bank that will fund it. We see it all the time. Let's talk about a self-directed 401k rollover. Well, none of the 5 C's apply here. This is a tax-free, debt-free, penalty-free way of funding your business. It's not considered a loan or debt. Basically, you're investing in your own business by rolling over your 401k or your IRA into it must be a new 401k. And you're self-directing the investment dollars to your own company instead of investing in other companies. As a result, you're able to utilize that money in your business. So it's a great way to invest in a startup, purchasing a franchise, or just purchasing an existing business. The cost is one-time $5,000, and monthly maintenance is around $150 per month. So though this is not a loan and it's not debt, there is a cost associated with leveraging your 401k in this way. So of course, it wouldn't make sense unless you had a substantial enough 401k where that $5,000 and $150 per month was worth it. Let's talk about credit card financing. 3 of the 5 C's apply here. Collateral is not required, so that's not one. Capital is not required. You don't have to make a deposit if you're qualified for the top tier credit cards. Capacity is important. They do want to know that if it's a business credit card, there's revenue in the company. And if it's a personal credit card, that you have income and stability. but most credit card applications are stated. Character, personal credit must be 720 or better. Now, yes, you can get approved for certain credit cards with less than 720 credit, but those are not going to be the best top tier credit cards. If you're looking to get the best credit cards, 0% promotional offers, the most powerful features and benefits on those credit cards, you have to have the best credit. Business credit is a plus, and by building your business credit, you can eventually qualify for business credit cards with no personal guarantee. The use of funds is very flexible with credit cards. So that's one really good thing with credit cards is that you can really use it how you want to. So it's not very specific or strict like an SBA loan. Top tier credit cards, interest rates after a 0% promotion are going to be right around 15% on average. If you kind of get an average, some are lower, some will be higher. What makes credit cards so powerful is that it's revolving debt, it's revolving credit. You can use it again and again, and if you take good care of it, it can increase if used properly, and you can also get new 0% promotions in the future. How about personal term loans? Well, 3 of the 5 C's apply here as well. No collateral is required. We don't need collateral for personal term loans. You do not have to, make a deposit. So capital is not required. Your income must be verifiable. So to get a personal term loan, you do have to be able to verify your personal income and show stability in most cases. Your personal credit must be at least a 680. Now, there are personal term loans that say 650, but I've really never seen anyone get approved for it less than a 680. So to be safe, we coach our clients 680 or better, verifiable income, and you should be able to qualify. The use of funds must be defined in some cases, but can also be flexible depending on which company you're getting that term loan from. And the interest rates average around 15%. They can be as low as 7%, and they could also be up to 20%. Average is around 15. We're seeing a lot of 9 and 10%, but depending on your credit and income, your DTI is a big part of this as well, your debt to income ratio. How about business term loans? Well, business term loans are very similar to personal term loans. The real difference is instead of looking at your personal income, they're looking at the business revenue and stability of the business. So at least 1 year in business, 1 year tax return, 6 months bank statements would be required for a legitimate business term loan. If you have business credit, it's really going to make a big difference to get a higher approval and to get much better rates. And the use of funds must be defined, but it can tend to be very flexible with business term loans as long as you're using it for your business. The interest rates, again, can average right around 15%. We've seen them as low as 6 and 7% and as high as 20%. But again, average can be around 15. But again, based on your business credit, personal credit, revenue, time in business, you can get really, really good rates as low as 7% and very attractive terms. How about an asset or collateral-based loan? Well, only one of the 5 C's apply here. Collateral. For example, luxury assets, cars, diamonds, fur coats, private jets, and yachts. So the asset has to be at least $50,000 or more in value. And ultimately, you're able to leverage that asset to secure a loan. You don't need to make a deposit. You don't have to worry about capacity. Your credit is not applicable. It does not matter. And neither are your use of funds. The interest rate on a asset-based collateral loan is typically around 3.99%. It's a monthly payment, a monthly interest-only payment at 3.99%. This is a month-to-month option. Your asset is placed in a secure facility and it is insured. Now, there's so many other options and we just don't have enough time to go over everything today. So on a one-on-one, we can go into these other options, including traditional bank loans, business lines of credit, private and hard money loans, invoice factoring, purchase order financing, equipment financing, and business or merchant cash advances. So let's talk about business credit. What about business credit? Well, building business credit organically can take anywhere from 6 to 12 months. Unlike personal credit, business credit is not automatic. It doesn't build itself like your personal credit. You have to be proactive to build it. Knowing or having the correct steps and instructions to build business credit can mean the difference between having great results or just wasting a lot of time and money. Having a strong business credit score does not automatically qualify you for business loans or lines of credit. In most cases, the 5 C's still apply, but having the business credit will allow you to separate the liability from your personal to your business, and in many cases can increase the funding amount and decrease your interest rate. So you can get much better terms and much more funding with business credit. Now, there are several agencies that report to business credit. Namely, number one is going to be Dun & Bradstreet. There's also Experian Business Credit and Equifax Business Credit. There's CreditSafe, LexisNexis, and PayNet. Which one of these matters? All of them do. The most important would be Dun & Bradstreet and Experian, but depending on your industry, PayNet or LexisNexis may also be very important for you to pay attention to. So how do you build business credit? Well, there's 3 stages. First, you have to establish business credit, you have to build it, and then you can access it. Some of the benefits include that you're able to separate that business liability from your personal liability. Typically, business credit comes with larger limits and lower interest rates. Business credit can open doors for vendor and industry-specific opportunities. It can lead to extremely large accounts and transactions, 10 times the amount of personal credit. Now, there are 10 basic requirements to establishing business credibility. Credibility is what the lenders and banks and the business credit bureaus look at to define that you are a legitimate business. Without this, you fail on your application on step 1. So the first item that defines you as being credible or legitimate is your business name. Your full legal name must be included on Dun & Bradstreet's and must match exactly as listed on corporation records. It must be included in your DBA. So your business name, full legal name, is very important. Your federal EIN or tax ID, establishing your employer identification number or your EIN, and matching your state filing exactly. Having all your required business licenses. There can be state licenses, there can be county licenses, city licenses that are not necessarily industry specific that you want to make sure you have in place as part of the credibility of your company. Your physical address. The business needs to own a physical address. Do not use a home address, PO box, or UPS address. You must have a separate business phone number, not a cell phone or mobile phone. It has to be a real business phone number. It can be a voice over IP business phone number, yes. You have to list that business phone number with 411 under the exact business name that you are using on your applications. You should have a business fax. So if you have to fax anything into your application, you're using your business fax and not someone else's or your personal. A business website. Folks, today your website is your storefront. You will need a professional business website that properly reflects your brand. Your website should also have your company phone, fax, address, and email. A professional email. You must have a professional business email, not a Yahoo or Gmail type email. You know, that's the difference between you treating your business as a business and as a hobby. And all your public records must be clear of any tax liens, judgments, or filings against your company. So to recap, you have to establish, build, and eventually you'll be able to access. There's two ways to do this. Number one, do it yourself. But that's a school of the hard knocks. This can cost you thousands of dollars. This can cost you countless hours of trial and error. And the other way is to learn from an expert with a proven track record. Your average person will take at least 6 months to 7 months to build their business credit. A very aggressive person can get it done within 3 to 5 months. And a slow to respond person can take up to 12 months to build their business credit. So building credit organically, it does not happen overnight. You have to take time to build it. And that's where we come into play. So there's 4 types of people, okay? One says, I just need funding now. I'll worry about building my business credit later. The second one says, I want to start building my business credit right now. I do not need and I don't want business funding at this time. The third person says, I want to do both. I want to build my business credit and I want to get started now, and I need to access funding right now. And the last person says, I'm not sure yet. I have some questions first. Maybe you're ready to go ahead and enroll in the $99 class, or you can schedule a call for a 15-minute consultation. In any event, I want to thank you for attending this webinar class on business credit building and funding. Please take a moment to give us a review and complete our short survey, and we'll talk to you soon.